Hello, welcome everybody to the Thursday edition of the Not Your Average Investor Show, where we are going over the JWB Rental Income Property of the Week. Today we're going to look at a property that's already been rented through 2023, and it also comes with a $2.4 thousand JWB Rent Credit to the buyer at close at 6125 Wilson Boulevard. But we're going to get into all of that. And we got another big win coming your way, because we are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show. Today is when we do our JWB Rental Income Property of the Week. I am your host with the shimmy and the shake, Pablo Gonzalez. And with me, as always, is the man that they call GC because of his genius concepts, because he generates cash flows, and because he's a great co-host, and because his name happens to be Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you on this fantastic Thursday.
It is a fantastic Thursday, Greg. We always look forward to the Property of the Week show because this is our tribe that shows up here week after week, and we always get somebody new that ends up joining the tribe and being part of the crew, and we love this stuff. So I want to welcome our usuals, our people returning: Leo, Denise, Bill, Lee, Lewis Carlson. That's the name that I'm recognizing as well. Nadeem, who has officially become a super regular. Ken Molina, past star of the show. Jake Hargrove with his trademark. Yo, welcome, Jake. And as Anthony did, another returning member of our community. And, you all know that this is an interactive show, especially Thursday. We want everybody chiming in. We want you asking questions. We want you talking to each other about the lessons learned. And there's two ways to do that. One is this chat that you already see blowing up and moving real quickly. And there is a little trick to the chat. When you first open it up, you're only speaking to Greg and I. But if you hit that blue button that says panelists and change it to panelists and attendees, everybody gets to see you. And I see some veterans in here because nobody so far is only talking to panelists. Michael Corbett, good afternoon. First time on the call. We hope that you make a place here with you in your heart and on your Thursdays and Tuesdays to hang out with us, and maybe join us in the Facebook group, which we'll talk about in a second. But the other move, Michael, that you may not know is that if you want to have your question asked on the show, we're about to get into the nitty gritty of the numbers here on a property real quick. And if you have anything that you want asked, please use the Q&A function. The reason why is just to, help me help you, right? This chat goes real quickly, and the Q&A that is in another part stays there on the screen. So I get to really keep track of it, make sure that your question gets answered. And my promise to you is that as you bring in the questions, I will start asking them immediately. So bring them in early. Lately, we've been getting a lot of questions on the call, so we don't get to all of them. So I encourage that whatever you got, whatever you want to hear from the genius concept man himself, bring it in the Q&A as early as possible, and I'll get you involved. Last but not least, if you want the tool that we are using, this ROI calculator that we like to use to analyze these properties so you can use it to analyze all of your deals, apples to apples, go to JWBROI.com. I'm going to put that in the chat in a second, and you can download this fancy little Excel sheet that I've been tinkering around with all day that you'll get to enjoy yourself. I think that's it, Greg. I think that's the intro. Let's talk about the raffle real quick. Give us a little bit of details on what is this 50-50 raffle? What's the money coming to? I'm gonna put in the link here in the chat for anybody that wants to get in. I just bought $100 worth of tickets last week because I want in on this.
Thank you, buddy. Thank you. Your donation really is going to change lives. That's what our goal is here at JWB. And one of the best ways we get to do it is through our charity golf tournament, which is a natural parlay into the best day of the year for JWB, which is the day that JWB gets to donate a brand new construction home that our network, everybody, you, me, Pablo, everybody on the call here has a part in. So we raise money through our charity golf tournament and throughout the year in an effort to be able to raise enough so that we can build a brand new construction home and give it to somebody who really needs a helping hand when it comes to housing. We've done this for 2 years prior to this one, and this is our third year of donating a brand new construction home. And we're doing this, we partner up with K9s for Warriors, which is a wonderful organization. They select a veteran who served our country admirably and who needs a helping hand. And we all come together to change that person's life. So that's happening on Monday as a charity golf tournament. We have the best MC in the world joining us for the charity golf tournament, Pablo.
Yeah. MC Pablo G.
And then Tuesday, we're actually going to give the home away to this veteran. The news stations are there. We've had interviews and whatnot. I mean, it's just like an incredible moment. So we have an opportunity for everybody on the call to be a part of this. Everybody who watches this on replay, you can be a part of this too, because we're donating one home a year. That's what we've done for the last 3 years now. This will be the 3rd year. Our goals are to do more than just one. And we really need everybody's support. We think there's a real possibility we may be able to do 2 homes come 2022. And it's a direct result of how much sponsorship dollars and how many donations we can raise. So we came up with a new way to raise money this year. Not only can you donate, you can be a part of this raffle. And so we unveiled this about a week or 2 ago and reached out to our clients, reached out to all of you on the group and whatnot. And there's been over $10,000 that has been donated that goes as a part of this raffle drawing. It's a 50-50 raffle. And 50% of what we raise goes to JWB Cares so we can build hopefully 2 new construction homes come 2022. The other 50% might go to you if you're the lucky winner. Everybody who donates now gets a chance to be the lucky raffle winner. So if you'd like to donate, you can go to jwbcares.org/events. There's a donate for the raffle in the middle of the page there, and you can donate. And it's $10 per ticket. And if you'd like to donate $100, you get 25 tickets. So there's an incentive to donate more. And all of this goes to an incredible cause. I wish all of you could be there the day that we literally get to change somebody's life, but you'll of course be there in spirit and watch the videos that we're going to be able to get from this thing. It's truly life-changing.
Gregg, I'm just going to put it out there. I donated because I love my country, so I appreciate the veterans. I love dogs. And I love to gamble, so I hope I win. So,
there you go. There you go.
You know what else I love, Gregg? I love breaking down properties with you live on this show. So let's get into it. We are headed to 6125 Wilson Boulevard. And let's pop it up on the screen right now. This home, as we have previously stated, is the property of the week. It has already been rented through 2023 and has a $2.4 thousand rent credit to the buyer at close. Now, as we are looking at this property, and for those of us that are new, we repurpose this into podcasts. So we are also speaking to our friend that's listening in their ear while they're walking their dog or they're at the gym right now. Thank you for joining us. I'm going to describe it to you a little bit. This house has a purchase price of $170,000. It is a 4-bedroom, 2.5 bathroom house with a 1-car garage. Estimated rent. So I'm guessing since this thing is rented out, the lease is $1,224 per month. And at the end of the day, this is what we're really looking for here. We're looking for this estimated conventional financing total monthly cash flow that is cash flowing at $206 per month. And it has a total estimated conventional financing ROI of 8.22%. And as is tradition, Gregg, I'm going to ask you to break down that cash flow for me. What does that $206 represent?
What that really should represent to you is one of the powerful things about rental property investing is that you can buy an asset. You can take out really smart debt on the asset, and that the asset is going to pay for itself every single month and then some. That's the real thing that you should see. You should even look beyond what $200 a month may do for you or whatnot. It's the fact that you can buy an asset, you can put good debt on it, and it's going to pay for itself every single month. Right? When you think about it through that lens, what this becomes then is a scalable model. And when it becomes scalable, that's how you can accomplish whatever your passive monthly income goal can be, right? The alternative would be if you buy something, you put good debt on it, but you don't make enough in rental income and it's cash flow negative, now you've got a liability every single month. Now, it doesn't sound so fun to go to 10 properties if you're $300 in the hole every single month, right? So the real thing to look at there, even keeping it really high level, is look at that and just think about how awesome it is that you're able to buy an asset, you can put good debt on it, and it still pays for itself and then some every single month.
That makes a lot of sense, Greg. This is the first time that I think you describe this thing as a scalable thing. And that makes a ton of sense, right? Like there is this misconception of you're buying rental income properties and maybe you're like in the hole, like 25, $100 a month, but you're going to make it up on appreciation or whatever speculative play you do. And that's one thing. But the idea that because it pays for itself, it becomes scalable because you're not now, like you can't buy 10 that you're $100 in a month. I had never really heard that coming out of your mouth. So I feel obliged to call it out, man. I think that's really, really interesting. So, but yeah. Tell us what it is in dollars and cents, right? So are you making $206 every month?
On a normal month. That $206 represents what will happen on a normal month, which will be the majority of months while you're owning the rental property. A normal month would be when rent is coming in and you have your normal expenses that happen every single month and affect your bank account. Those normal expenses would be your principal payments, your interest payments on your loan, your property taxes, and your property insurance costs, as well as your property management fees. So basically to get to that $206, you got the rental income coming in, you take out those normal expenses, and that's what a normal month is going to look like for you. And so that's what you'll see on this rental property.
Okay, that makes sense. Now, the last obligatory question, and then we're going to go jump right into Lee Bishop already has a great question. So explain to us real quick, what is the difference between that cash flow and the estimated conventional financing total ROI of 8.22%?
Well, you need to pay attention to both of those figures. So I'm glad we break it down like we always do. These are the two things I want you to look at when evaluating a rental property, even before the price, even before the picture, even before the rent amount. You need to be paying attention to these two things. So 8.22% represents a more holistic view of other profit centers in the deal, right? $206 a month is a rather myopic way to look at the rental property. Return on investment takes into account, it's kind of like the great equalizer. It takes into account your purchase price, your rental amount, all these other expenses, in addition to the normal expenses that I just described. And it also takes into account two other profit centers, your tax savings and your principal pay down. Those are two profit centers that you may not be considering, but are super powerful and the best reasons to be investing in rental properties. So specifically, to get to 8.22%, you start with your rental income. You take out your normal expenses, which is what I just talked about, your principal, interest, taxes, and insurance. You take out your monthly property management fees. You also take out your tenant placement fees. Tenant placement fees are there when a new resident is put in your home, and there is going to be a resident put in your home. This home actually already has a resident put in. So there's a tenant placement fee associated with that. We need to account for that in your return on investment. It also takes into account expected maintenance and vacancy cost. These don't happen every single month for you, but we know over time they are going to happen. And part of the secret about actually enjoying rental property investing is knowing what to expect, knowing these maintenance and vacancy costs and what they should come in at over the long haul. And so we build those costs into the expectations for you so that we can still under promise and over deliver and hit those return expectations for you. Takes all those things into account. You put all that in, you divide it by your initial investment, which does include your closing costs as well, which is something that a lot of turnkey companies leave out. And you get all that together, you divide all that by the initial investment, and you're left with over an 8% return on investment.
Beautiful. Beautiful. Michael Madonia, you're putting some stuff in the chat. If you don't mind, can you put it into Q&A so that I can keep better track of it? But we're going to get into exactly what you're asking about right now. Greg, you bring up the maintenance and the vacancy costs and whatnot, right? Lee Bishop has in the Q&A right now. Greg, this property has a vacancy rate that's a bit higher. Is that due to the coming year? Also, the maintenance rate seems a bit higher. How come it is not the 6% that we're used to seeing?
Great questions, Lee. This is a really important topic to talk about because when you're buying rental properties, the normal way to do it, if you're buying it by yourself, you probably have no kind of perspective of what your maintenance costs should be, right? It's unlikely that you have a large enough portfolio and have held it long enough to really get averages to see what you should expect as far as maintenance costs and vacancy costs each year. And if we even go beyond, if you're just doing this yourself, if you're working with another turnkey company, it's unlikely that that turnkey company actually has that information where they can project what their maintenance costs and vacancy costs are. Because most companies that sell you rental properties don't actually do the property management for you. And unless you work with a vertically integrated company who does the property management for you, it's impossible for them to have real data points on what your maintenance and vacancy costs should be. But Pablo, do you know what your biggest pain points will be as a rental property investor?
My biggest pain point as a rental property investor has got to be property management, right?
Kind of.
More specific?
Yeah.
My biggest pain point would
with
be
maintenance.
Huh? Is it maintenance?
Close. You were close. I mean, it is part of the property management discussion, right? The biggest pain points for a property management relationship revolve around when you get hit with a big maintenance bill or a big vacancy expense, right? So it never made sense to me that if my clients, the biggest pain point for my clients revolves around maintenance costs and vacancy costs, it never made sense for me why I would fly blind and put generic expectations out there for what maintenance and vacancy costs are, because they are highly determined by the quality of the construction or the renovation, and they're highly determined by the quality of the property management, which is you can never have that be the same from one company to another, right? There are huge differences there. So it never made sense to me why all of these companies out here and all of these rental property investors would use just these random expectations, right? You might see 5% for vacancy cost and 7% for maintenance cost, or 5% for vacancy cost, 5% for maintenance cost. But none of that has any data behind it for the most part. I've yet to see another turnkey rental property company that can actually back that up with data. We're the only ones who actually track it. So your chances of actually having real data is slim, because very few companies that actually sell you turnkey rental properties actually do the property management, so they don't know the data. But even if they did, nobody goes through and tracks it. So all that being said, I am on my soapbox a little bit here because I think this really matters. But all that being said, JWB does it differently. We have been tracking every dollar in and every dollar out for our maintenance costs since 2011. It's over 2,000 properties that have been sold to our clients that we continue to do the management on. We have this incredible amount of data that we can learn from. And that's what we do. So we're able to look, and if there are key things that we see as far as different maintenance cost assumptions, then we're gonna reflect those differently on this evaluation than you would for another evaluation. So Lee asked, is the vacancy rate a little bit different here? Is the maintenance rate a little bit different here than what we've seen in the past? For those who joined the property of the week, last week was the new construction home, if I remember.
That's right.
New construction for us has been shown to have a 3% vacancy cost on average each year. And it's been shown to have a 4% maintenance rate. So that's what you saw for the new construction home. Now, what we're seeing here is a renovated home. And renovations have slightly higher vacancy and slightly higher maintenance costs. Now, we're going to talk in a second about why that's okay, right? Why we still believe in renovations. We'll talk about that in a second. But the reality is that you're going to see slightly higher maintenance costs and vacancy costs for a renovation. And so all of this, from what I'm showing you here, 4% vacancy rate, 9% maintenance rate, is backed by data. It's backed by literally thousands of properties that have been iterated month after month, year over year, that we've managed. We've been able to see over time, what do all these costs come in as a percentage of the rent collected. So we do this for whether it's a new construction home or whether it's a renovation, and then whether it's a septic home or if it's on city sewer, you'll see some slight differences. Like, for example, if this home was on city sewer, they would have a 6% maintenance rate, but this one is on septic. And so we know this in advance. And the reason that it makes sense for you to continue to buy properties, even if they have a 9% maintenance rate here, is because in order for us to hit our overall goals, right, to be at that over 8% return on investment number, the deal has to be a little bit better in other places, right? We're incurring an additional expense. We have to have a little bit more income, right? Or the purchase price has to be a little bit lower. And that's why at the end of the day, you'll still see between 8 to 10% returns on investment, no matter what you see from JWB. It's just a matter of how you get there.
There you go. So to summarize it all up to Lee and Michael Madonia, who also asked this in the chat, where do these numbers come from? They come from real life data, from the fact that JWB is a perfectly vertically integrated company that sees the entire scope, including the property management. They have 3,000 homes in the area, and they track every single number, right? Like they have a data flywheel, as we call it, that informs every decision that they make going forward, that empowers them to win on the next deal and empowers you to win on the next deal. Greg, this is a good time we just talked about the neighborhood, right? And we have a question here in the chat that is Daniel Kane asking us. Daniel, I think this is your first time coming. Welcome. He's asking, how is the quality of the neighborhood? I want to show here kind of this whole thing that we were just talking about, of all the data points that y'all have here.
Absolutely.
So help me out, Greg. I don't want to mess this up and search the wrong area. Where around where is this? This is 32210?
That's right. If you're, it's the west side there. So kind of where the cursor is right there, maybe a little bit to the east there. Yeah, there you go. Right around there is kind of where we are. Maybe a little bit to the east there. That's 32210. So looking on the screen here, all of these blue markers here are all of the properties that we've sold to turnkey clients over the years that we continue to do the management on. If you count up all those blue dots, there'd be over 2,000 properties like we've been talking about here. So lots of experience that will be to your benefit, because we do the same thing over and over and over again. So when we set rent rates, when we know within a very high degree of what property taxes are going to be, when we know what insurance costs are going to be, when we know how to get your home rented for that amount, when we make sure that the sales price is based on market value for what has sold recently in the area, all of those things are relatively easy for us to do because you have all of these data points that we're looking at. I think a lot of his question is about the quality of the neighborhood as well, sort of maybe the characteristics of the neighborhood.
Yeah.
And that's always an interesting and fun and topic to get into. It's a little bit, subjective. So I try to make it as objective as possible. And I try to set low expectations when it comes to neighborhood quality, right? The first place I start when talking about neighborhoods for this type of a model to be investing in rental properties here is that there is no perfect investment out there. And for this model to work for you, you have to be comfortable investing in below middle income neighborhoods. Because if you go to above middle income neighborhoods, Pablo, are you going to find positive cash flow like $200 a month if you go to an above middle income neighborhood?
You are not going to find positive cash flow in above middle income neighborhoods in Jacksonville. And the other thing that I have learned from you is that you also run a higher risk of vacancy, because in a higher income rental neighborhood, that marginal cost of rent is a decision between investing in an increased lifestyle versus investing in something else. So when stuff goes south, which we saw during COVID, people that are in these lower income neighborhoods, that's the amount of money they got to pay for housing, period. It's not a decision for them, right? So everything stayed rented during COVID, and you were able to hit your 97%.
Yeah, you're like Gregg Cohen over there, man. You just take one topic and you just speak for another like 5 minutes on something. I love that, man.
Greatest compliment ever.
I've been heard that I'm a talker. I've heard that a few times. So yeah, I mean, just like you said, there's real risk mitigation in being in below middle income neighborhoods. The best risk mitigation is that you're going to have positive cash flow every single month instead of negative cash flow. Another risk mitigation that Pablo's talking about is simply you have more demand for renting in those neighborhoods. So that's why we go into these below middle income neighborhoods with eyes wide open. We understand that they are not above middle income neighborhoods, right? So with that context, what we're talking about here is this is an ideal positive cash flow below middle income neighborhood, right? That means that there's low prices, there's high rents, and you're surrounded by jobs. This is an area that obviously we have extensive experience managing homes here. We know pretty much everything about how to find the ideal resident and help them stay there forever, right? That's what our goal is there. To the downside, in a below middle income neighborhood, you would expect below average schools. I get questions about schools a lot. And I tell people that I wish that there were above average schools, but there's no perfect investment out there. And for this model to work, there are so many other positives that if you can get yourself to a place where you're comfortable investing in a below middle income neighborhood with below average schools, then this might be the right model for you. And the reason why that still makes sense is because many people think I need to be in above average school districts because that's the only way to get residents to stay long. And our entire property management company has been built on the idea that we need to achieve long-term resident stays, and we can do that even if we're in school districts that are below middle income and below average schools. So this is a working class neighborhood. This is below middle income. It is not going to knock your socks off as the nicest neighborhood you ever go to, but it's something that, if you ever get the chance to come to Jacksonville, it's certainly not a low income neighborhood. That's where we stay away from.
Yeah. And Marilyn Connerman from Homosassa, Florida,
home of the manatees.
She's got a question here that I think is very astute. And I don't know if you hit on jobs in the neighborhoods that we're talking about, but she asks, is this house near the newest Amazon facility?
Yeah, not too far. I don't know if you can kind of pull that up and get a direction or a distance there on the fly there, Bob. I know this is the first time you're wheeling and dealing with the new map thing, but
my fear is that if I do that, all these other properties are going to go away.
Yeah,
it's that just happened. All right.
It's not far. It's not far. So last week we were talking about the new construction home on Alvin Road, which was on right off of 103rd, and 103rd is very close to Wilson Boulevard as well. So I'm guessing 5 to 10 miles max from the Amazon facility. This is also close to the largest Navy base that we have here in Jacksonville. It's called NAS Jax, Naval Air Station Jacksonville, over 20,000 jobs on base right there. And so the west side is a real hotbed for jobs. I mean, it's only a 15-minute drive to downtown Jacksonville, which is, where we have the largest concentration of jobs, over 55,000 jobs in downtown Jacksonville. So you're surrounded by jobs. That's why one of the reasons why we love the west side.
Yeah. And in general, Greg, just to clear it up, your requirements on a neighborhood are that below middle income, above average rent, within 15-minute drive of how many jobs, like 60,000 jobs or something like that? Or
I mean, these 4 neighborhoods probably all meet that criteria. We established these neighborhoods literally when I started to put my own money in rental property investing in 2006. And I don't think I sat down and actually gave the criteria at that time. But, you've got these major job creators, no matter which of the 4 neighborhoods we put you in Jacksonville, right? I could paint a picture of over 60,000 jobs within, a 15-minute drive for the west side, like I just have, which is very real. I could also tell you about Amazon facilities in the north side, which are also within a 5 to 10 minute drive of our neighborhood. And our neighborhoods are a 15-minute drive from downtown Jacksonville as well. I could also talk about the Port of Jacksonville, which serves our north side communities and is a huge economic driver of jobs here in the north side. I could also talk about Arlington, which is also served by the Port as well. And we have our universities in Arlington, the Jacksonville University. And I could talk about the South Side, but all of these things are done with this in mind, right? We locate those sweet spots, which are low prices, high rents, and surrounded by jobs. And we've stuck our flag in the ground and we just try to dominate those areas for our clients because this is where the model works. Again, kind of get to the original question was what's the quality of the neighborhood? Quality of the neighborhood is so subjective. If you feel like you need to be buying rental properties that meet a criteria of like you always want to live there yourself, or you could like leave wherever you live and want to come and live there for 6 months or whatnot. I don't know if that's real or not for people because everybody's different, but I would suggest that should have no bearing on it, right? You should understand that you're investing in the quality of the neighborhood that you're typically going to find in a below middle income neighborhood, and understand that that's a wonderful value for a resident. The housing you're creating for a resident is a wonderful value, and you're creating a wonderful investment for yourself. And it has no bearing on whether or not you would want to live there yourself.
That was a wonderful answer, Greg. Thank you very much. Let's move on to Patrick Mills has a question. I think Patrick's might be new as well, but he asks, where do I find this property on your website? Under what link? Thanks.
Great question. So for years and years and years now, we have not posted our properties on our website. And the reality is that properties sell really quickly. It's a lot of it based on our personalized approach with our clients. You know, all of our clients have buying plans with us. And so we understand literally years in advance when they're going to be buying properties. So that helps us sell properties quickly. And then through our process with our team, we're very much like when we bring a new client on, we're not just going to start throwing you properties so that you might be able to buy or put an offer in or any of that. It's a very personalized advisory approach, right? We're going to learn about you. And then until we get to that point, we feel like there's going to be value when we take this entire world of whatever potential rental properties you can invest, and then we serve to you 3 or 5 that hit your criteria and allow you to choose. That's just a part of our sales process there. So, and then at the end of the day, things sell really quickly. So it made no sense for us to constantly put properties on the site just to create more work for my team that would then change constantly over and over and over again. So for years and years and years, we never have done that. Even, and then today I will share with you that properties are selling so fast now. And that's just the state. That's not because JWB is the end all be all and the best thing ever. That's more market driven than anything else, right? Right now, everybody wants to get into rental properties, and they want to do it because it's an incredible investment and because the interest rates are so low, and they recognize the opportunity to build generational wealth. So I've never seen properties sell quicker than they are right now, which would just make that premise of kind of wasting my team's time to put it on the website just to change it even more kind of not something that we would do. So what I would encourage you to do for anybody who's interested in properties, we make this really simple. We always have a set of properties that have recently sold available for you to look at. So you can go to the site, which is jwbrealestate.com. You'll see a view properties link, and you can go ahead and you can view those properties that have just recently sold. And everything that we show you there is easily replicable for you when it comes time for you to purchase the home. So when it comes time, when you have a few phone calls with my team, sit down, we understand what your goals are. The properties we put in front of you at that point are going to fall right in line with those 3 properties that you just looked at that just recently sold. And so that's the best way that we found to make sure that everybody has insight into how properties are, while also just understanding and respecting the process now, which is properties sell very quickly.
Got it, Greg. So Denise puts in the chat, welcome back, Denise. I can attest. I told Stet, which is Mike Stetson, the sales guy, I was interested in 2 and they were already gone. So I quickly picked 2 others. So that's awesome. They're flying off the shelf right now. Right. But like at the end of the day, Greg, I know that you differentiate yourself, and since you're so deep and so vertically integrated into Jacksonville, you have this assembly line of new construction properties and renovated properties that you have been investing in inventory for years and years and years, so that unlike any other turnkey rental income property company, you always have inventory available. You're never going to put anybody on a wait list, right? So that being said, yeah. Daniel Kane had a second part to his question that I purposefully left for the end because I really like answering this question. But Daniel Kane asks, why is the appreciation rate 0%?
Oh, fantastic. Perfect segue. Pablo, you want to take this one? I feel like I've been talking a lot here. Do you want to bridge the gap on this one?
Oh my God, I never thought you would ask. Yeah, listen, Daniel. So first of all, I am as the host of the show, I am a marketing consultant to JWB that only plays a real estate expert on TV. And I've only gotten here because I've spent the past year asking Greg intelligent questions coming from other people, not coming from myself. But what I have learned is that appreciation rate is only predictable. You're only able to count on it when you are in for a long-term investment for one full market cycle. And that is somewhere between 10 to 20 years, right? So I know that Greg and JWB, their company, their number one core value is to underpromise and overdeliver. So they're only going to promise you stuff that they know that they can deliver on. And they're generally promising you a little bit less than what they know that they can deliver on, right? So they know that they can deliver on this thing right here and this thing right here, the cash flow and the ROI, but they don't control how long you hold the property. So in these past couple of weeks, we have now been updated with the idea that short-term appreciation in Jacksonville is 8 to 10% for this year for appreciation of homes. but long-term appreciation rate in Jacksonville historically is 4.3%, right? So they don't populate that into the spreadsheet because, again, it becomes a variable. It becomes a variable on how long you're going to hold on to the asset, and they'll only going to, bring you into this if you have a long-term perspective. That being said, when we do put in the 4.3 appreciation rate here, this is a live spreadsheet. I'm going to hit enter. And this is one of the first tricks, one of the first things that really blew my mind when I was running through these calls with Gregg when we first started this, is this jump from 8% to 23.85% kind of left me dumbfounded. And really the way that is explained is this is leverage at work, right? So if you are going in with this conventional financing and you're financing a home that's $170,000 and you're putting 25% down, I'm going to do some quick math. That's going to be somewhere around like $42,500. You can check me on that, Gregg. I think it's pretty good.
Nailed it.
Nailed it. All right. $42,500. And as your property appreciates, you're going to be getting interest on that $170,000, even though you put in $42,500, right? So that means that the ROI you're getting on the money that you put down is actually leverage, and it's multiplied by 4, which leads to this extra, 16% or 15% return on ROI. Gregg, I blacked out. How did I do?
Oh my goodness, man. You nailed it. You're getting so much props in the chat too. I think Lee, who's saying, I'm seeing somebody just said this dude is money. Bill Shields, like, wow, man. Honestly, that was one of the coolest things in our evolution of the show and our evolution of friend and, client, whatnot. You nailed that, brother. I'm super proud.
Awesome, man. And anything to add? Should I take it back off? Let's go back down to the base assumption. Oh, you know what there is to add is Margaret Smith had something that we want to add to this thing. Margaret Smith asks, I know you're going to discuss the expectation of 4.3% appreciation, but her question is, how does the appreciation, the historical 4.3 appreciation rate, how does that affect when it comes to quality of the neighborhood? Is a higher income neighborhood have better appreciation, lower income, more appreciation?
So the simple answer is when you take a very macro outlook on appreciation, those variables are all taken into account. And we don't see any data to show that higher income neighborhoods over a full market cycle appreciate more than lower income neighborhoods, or the opposite, right? Or lower income neighborhoods would appreciate more than higher income neighborhoods. That's part of the beauty of looking at this from a macro sense and investing in something that you believe based on data is going to go up in value. You've seen that it repeats itself over a certain amount of time, and then you go in and you let it ride. I mean, that's kind of the beauty of this. It kind of removes a lot of those variables from the equation. To give you some short-term information on appreciation, many people would assume if you were going to choose one segment of the housing stock that you would see higher home price appreciation in the higher end and lower home price appreciation in the lower end. But the data over the last decade is actually contrary to that. The lower price neighborhoods that we serve in Jacksonville, and even the low income neighborhoods in Jacksonville that we do not serve, have actually appreciated on a percentage basis higher than many of the higher end homes. That doesn't mean to say that always lower end is going to appreciate them as higher or whatnot, but that's just a contrarian data point that many people aren't aware of. And so at the end of the day, I think you just kind of understand what your historical home price appreciation rate is for that area, that metropolitan statistical area or MSA. You know that over a 10 or a 20-year cycle, history repeating itself is very likely because that's what's happened over past 10, 15, 20-year cycles. And then if you have a mentality of holding on for the next 10 to 20 years, you're probably going to find that your average year-over-year appreciation is going to be right around that same number. In Jacksonville, it's about 4.3%. It will probably be right about that when we're doing this show 20 years from now.
There you go. So contrary to popular belief, macro level, it's all the same. But if you really want to dig down, the lower income neighborhoods actually appreciate higher. And Denise S has a little data point to add in right here. She says, one house I purchased in November, new construction already rented, lost a tenant in the last few weeks and already already and was only vacant for a few weeks. The new tenant's lease is for $100 more per month than the previous tenant that had 2 years lease. So in addition to homes appreciating, rents are also rising. Which is interesting.
We are absolutely seeing that. Absolutely.
Thanks. Awesome, man. All right. So Michael Corbett has another question. I see this property sold for $130,000 last summer. Is that accurate? And what accounts for the $47,000 increase?
Yeah, actually, I asked my team about that because not all that is profit. And so part of that, obviously, there's always selling, holding, and closing costs that we're going to bear. That would come out of that 47,000, I think was the number there. But we actually take on additional work to bring this home up to the JWB standard. So there's additional expenses that we spend money on while we own the home that is not passed on to our clients, and that would decrease our profit margin on that one. So JWB isn't making $47,000 or anything close to that on this one. Our typical profits are around $15,000, $20,000.
Got it. So, speaking of those holding costs, Greg, do you want to talk about what's up with this rent credit thing? If it's already rented for 2 years, why does it come with a $2,400 JWB rent credit?
That's a great question. So, many times, if we're thinking about what I just shared with you, while, homes are selling faster than ever, it's a lot of that is market driven, right? Obviously, a part of that is JWB doing a good job and having repeat sales and all that good stuff. But if homes are selling really quickly and this home is already rented, and I just shared with you that we put more money into the deal, into the renovation to bring it up to the JWB standard, why on earth would JWB be giving a rent credit on top of that? It's not like we need that incentive to sell the house. So why does JWB do this? Well, the reason we do this is because we're trying to create a win-win-win situation here. So when we acquire this home, this one actually had a resident in place, and the resident was paying below market rent. Now, in order for us to acquire this home, there was a lease in place already. So JWB couldn't even buy this home with the intention of not honoring that lease. That is a non-starter. Even if we were terrible people, we wouldn't be able to do that by the letter of the law. And we wouldn't do that anyways because we're not terrible people. So in order for us to actually buy this asset and make it an asset that can sell, we need to come up with a strategy to keep that wonderful resident in the home. Residents in there, they've already signed a long-term lease. They're through 2023. Things are going well. No reason to rock the boat there. So we go into that and we say, okay, how can we keep this resident there? We know that the rent there is below market rent though. How are we going to make this a win for the client on the back end? Well, what we do is we understand what full market value is. And that of course is always our sales price. And in order to bridge the gap, what JWB does is we give a rent credit that's equal to 2 years of the difference in that rent. So this is under rented by $100 at the moment. And so 24 months times $100 is $2,400. So what we've done here is we've created a win for everybody here to make this an asset that a client can purchase, JWB can sell, and the resident can stay in the home and still deliver that return on investment. And what a lot of people don't understand with that rent credit is it's not like you get $100 every single month from JWB. We want to make it simple and it's to your benefit. So we just pay you that $2,400 day one. So that's really important because like Denise just brought up an example, right? Sometimes things don't go 100% perfect in rental properties, right? Denise was just talking, I believe, about how one of the properties she purchased in the short run, the resident moved out. It's not perfect. That can't happen. Well, if Denise had a rent credit here, she would have received this $2,400 at closing on that home, which is incredible for her because her returns day one go way up, right? She receives that no matter how long that next resident stays in the home. Now, I think in Denise's case, and Denise, feel free to fill me in on the chat here, but it sounds like after a few months there was an issue. The resident moved out. We got a new resident in a relatively short period of time, and that new resident paid additional rent of $100 more, right? Well, in that case, Denise would have earned the $2,400 rent credit, and then she'd be right at market rent for the remaining amount of time on that lease that was just signed, So there's a real value in getting this rent credit day one. It's a protection in addition to anything else that goes along with the property. And it's not scaled back if for some reason that resident doesn't stay for a full 2 years. And I've never fully explained that, but there's real value in getting it day one rather than, getting that market rent over the next 2 years.
There you go. Just another example of stuff that you guys do to go over and beyond the customer experience, right? Like you and I have spoken so much about that, like micro level customer experience where you just try to make sure that there is never a moment where it is, you make up for any kind of like bad thing with whatever you can do to make it better, which I've learned a lot from and trying to grow my business, to be perfectly honest. So Gregory Stone asks, so with the vacancy and maintenance, is that on a yearly basis, and that if you already have reserves set aside for that, you don't need to keep taking it out all the time, correct?
A couple things. It is on an annual basis. If anybody wants to follow along at home, just take that rent, which is $1,224, multiply it times 12, which gives you the annual rent. And then for vacancy rate, multiply it times 4%. I don't have, let's see, get my phone here. We'll do it together here. Boom, 1224 times 12 times 0.04 means $587 a year on average is what you should be planning on that vacancy expense being, meaning the lost rent. For the maintenance cost, it'd be 1224 times 12 times 0.09. That would be $1,321 a year set aside and expected in your maintenance costs. And if that happens on average year over year over year, then we're going to be in a great spot to hit our return on investment. So that's how it's calculated. Now, the question was, do you need to continue to set money aside? I always recommend having a safety net, a buffer, and doing this in the beginning when you buy rental properties. Again, because I know what your biggest pain point is going to be. The biggest pain point for you is a maintenance cost that requires you to take from your personal bank account to pay for an expense that somebody else caused in your rental property. It's like, if you weren't expecting it and it has to come from your personal bank account to pay for it, that's when you're like, oh man, this sucks, right? In reality, it might be totally in line with what your return on investment expectations are. But that simple taking it from your personal bank account will cause pain and stress. So why not avoid that, right? What I recommend is setting aside a maintenance and vacancy buffer in the beginning. And this might be 3,000, maybe 5,000, depending on what your level of frustration you may have would be, right? And how much money you want to tie up. Somewhere around there is really a healthy amount. Set that aside, put that in that bank account. And then your property should, at that point, if you've got that set aside, you don't need to set aside additional maintenance and vacancy reserves because you've already sort of done that. You've done it in advance. And this will just help with the experience of it all. What it'll also do is you now have one bank account that you are paying your mortgage payment out of, that you've got the rent coming in from JWB, that you may have maintenance expenses coming out of. And sometimes the movement of money is not always 100% perfect. So you got a buffer there, right? If your payment to the bank needs to come out on this day and then the rental income comes on this day, you give yourself a little bit of wiggle room. It's just a little bit easier to manage the money.
All right. That makes a lot of sense. Greg, we got 14 questions in the chat and we got about 10 minutes to go. So I'm going to prioritize a couple of our first timers here that want their questions asked. And Abby Falladin, first timer here. Welcome, Abby. Hope that you return and get educated on rental income properties as much as possible. But she's got 3 questions that I'm just going to ask because I think you can answer them pretty seamlessly. First time here, need more info on the general practice of this company, please. And then she asks, are you in South Florida? She asks, is this only for turnkey properties with immediate cash flow? And then she asks, what distinguishes you from companies like Morris Invest and other turnkey investing companies out there? I'm trying to grow my SDIRA exponentially. What products do you have in place to help me achieve my goals? Go for it, Greg.
Awesome questions, Abby. Thank you so much for being here. I think everybody's going to benefit from the questions that you asked. So super appreciative. Your first question, more information on the general practice and are we in South Florida? We're not in South Florida. What we do, we're a vertically integrated company that sells turnkey rental properties. We do the property management and we are 100% focused on Jacksonville. We do this because we believe there's a real value, and you guys have heard me talk about this term, vertically integrated. I don't think people really understand how important it is to be working with a company that does a whole lot more than just sell you the house, that does a whole lot more than just renovates the house. a whole lot more than just does the property management. Now, that's a big differentiator right there. I'll let you know. Very few companies out there that sell you rental properties actually do the property management. So there's one differentiator. But there's a lot more. I think you need to work with a company that is focused on the long-term growth of your investments. A company that actually is a player in the downtown revitalization, which is going to affect not just your rents going up and your home prices hopefully going up in the future, but attracting top quality talent to this area, right? Because what people don't often think about is supply and demand is one part that affects housing prices and rents, but the other part that affects housing prices and rents is making sure that it's affordable. And the way that you extend the runway and extend the possibilities of a better return for you is by raising median incomes in your area. So that's one of the reasons that we are 100% focused on Jacksonville. And I recognize this is your first time on the show. We've done a lot of our shows talking about why JWB is buying buildings downtown, right? We aren't buying buildings downtown to sell for investors. There's a lot of risk at buying dilapidated building downtown and then renovating them. Like this is like an $18 million renovation project that we're taking on for a building downtown. Why are we doing that? Well, it fits perfectly in line with this message that we have for our clients, which we are the best risk-adjusted return possible when you invest in rental properties because we're vertically integrated, right? There's no other company that I know of that does more locally, whether they're making investments, whether they're helping the community, than JWB does. And that's the real definition for me of what vertically integrated should be. It's way more than just do they only do the property management? Because the biggest things I look at this is how can I put your money in the best chance for success in 10 years or in 20 years? And you got to go beyond just doing great property management in-house, in my opinion. You got to be working with key players downtown. You got to be in the news all the time as a mover and shaker and actually buying and renovating literally tens of millions of dollars of buildings downtown, right? You got to be on the other end too with like the charity work that we do. And I, we're so blessed to do this charity work. We do it for the right reasons, but at the end of the day, this is improving our community on the back end, right? So that's really my definition of what vertically integrated is. And I am just of the belief that if you're going to put your money in a market, you better work with somebody who is not just thinking myopically about how can I renovate this or sell this the best way, how can I just manage this? How can I protect your money for the next 10 or 20 years? So that would be the big differentiator for us. You won't find another company here in the country that does all of those things that I just laid out.
Man, that one got me going, Gregg. I love watching you answer that question. Abby, I can tell you as somebody that is from South Florida, invested with JWB 8 years ago without really understanding it and pulled out of my investment prematurely. What I didn't understand is this vertical integration concept in the sense that on a very simple level, if you want to take it away from being part of downtown and the fact that they really have true influence in the metro area that actually drives pricing and wages and stuff like that, because they do so much, is the fact that JWB owns the land that is going to have a house on it, that they then build or renovate, that they then make sure that you have a tenant in and manage the life of the tenant and have their own tenant acquisition process and a whole sophisticated marketing funnel to be able to replace a tenant so quickly like they did with Denise. And they own it right next to you. They're owning in the same neighborhoods next to you. And they give you a portfolio manager that you talk to once a month that tells you what to do with your money so that you can continue to buy houses. Gregg, when I came on board to help him create this show and create this like marketing message, he told me real quick that their end game is to get everybody that buys one house to buy 3 houses. And they do that by creating long-term incentivization for the tenant, for the client, and for themselves to all be on the same page. So they are vertically integrated as an operation, as a member of society, but they're also vertically integrated in the incentives that they align with for every player along the funnel, which has been super eye-opening for me as a person that just likes business in general. So Just wanted to add that piece. Yeah, man, you got it too. All right, I'm going to keep prioritizing our newbies in our community, right? Because we want you coming back. Elite Despendent, I hope I pronounced that correctly, asks, is there a requirement for flood insurance in these areas?
Generally, no. We're going to put you in neighborhoods, generally speaking, that are not in the flood zones, which would require flood insurance. So the answer is no there.
There you go. Daniel Kane has a couple of questions here. Number one, he says, looks like you're projecting 1 month over 2 years vacant. Greg, can you explain that?
Yeah, we sign long-term leases. So the lease that we sign for our rental properties is either a 2 or a 3-year lease, which is incredible. On top of that, we renew residents at a pace of over 70%. 71% was actually the number that we accomplished in the year 2020, which led us to an average duration of resident stay of 54 months, so over 4 years. So when you're able to not have to lose rent or not have to replace a resident for 4.5 years on average, your vacancy cost each year is going to go lower and lower and lower. And that's really our charge as a management company. How can we lower your maintenance and your vacancy costs? That's what we're here to do.
Awesome, Greg. Abby, I see you asking questions in the chat to Lee. So 2 things. Number one, you're only talking to panelists. You got to change to panelists and attendees if you want to talk to everybody else in the chat. But I would also encourage you that same question that you asked, we have a Facebook group that has over 2,300 investors and people that are curious about rental income properties. And if what you're looking for is, so short answer to your question, Lee does not work for us and he's not a panelist or anything like that. He's a super consumer, right? Like he is all in on what we sell and he's a very valued member of our community. But we have a bunch of people in our Facebook group that you can ask very candid questions to. You can ask anything you want. There's a really, really high collective wisdom and collective impact in there in the Facebook group. So that's at jwbfacebookgroup.com. You can join there and let us expose our guts, right? Like that is kind of the whole purpose of this thing is to be as transparent as possible so that people that want to do business here enroll because they know everything and they feel as comfortable as possible. Speaking of comfortable as possible, Greg, how comfortable are you with our time right now, man? You got to get going?
Let me just double check here. See what we got going on here.
In the meantime, I'm putting the Facebook group.
I'm good. Maybe another 15 minutes or so. Sound about right?
Yeah, man, whatever you got going on. I don't have anything till 2:00 and then that's to stuff my face with food. So, all right, here we go. Nadeem Shah asks, can the closing cost be included in the financing package? Is that a good practice?
So, well, number one, your closing costs are included in the return on investment. So I think that's great for setting your expectations there. Not a lot of investors include that in their return on investment expectations. So you're good from that perspective. I think you're asking about rolling your closing costs into it. Generally doesn't work when you're buying properties. You would have to buy properties below market value in order for that to work generally. So typically doesn't work. Well, it doesn't work for JWB because all of our homes are sold at market value. So my answer would be if you're buying it outside of JWB, if you're buying it under market value because you're putting the work in and finding a great deal, and that's something, sure, I think that's a great idea because it limits your out of pocket, just typically won't work for a JWB or a turnkey property.
Right on. Marilyn Cotterman from Homosassa, Florida,
home of the manatees,
has a question. What various types of impact will the $15 minimum wage have on rentals for both renters and investors? You got a take on that, Greg?
Oh man, I don't have a formed thought on that. I see a lot of different perspectives. I think that can be a little bit of a lightning rod topic there. So I think I'm going to let me think about that a little bit more and get back to you on a future show and come up with a thought on that one.
Future show, Facebook group. But Abby, to your point of transparency, Greg will never answer anything that he doesn't really actually know how to answer. So that's part of the reason why people trust him. Michael James has a question. What are you considering below income?
Yeah, below income, I think is what he's asking about, right? There's low income, there's below middle income, above middle income, high income. So low income are those neighborhoods that have a high preponderance of violent crime, right? At the end of the day, when I think about it in terms of maintenance and vacancy costs, which again are going to be your biggest pain points, they're going to result in the highest maintenance and vacancy costs for you because there's higher turnover because the residents that you get there tend to not stay as long. So it's highly subjective, let's be honest, right? Low income from one person might be below middle income from another, or vice versa, right? The easiest way to do it is just look at the median income level, the median home sales price level of your market. And then half of that would be like low income, right? That's where low income, the highest amount of low income, right? It's like, that's like the 25% median home sales price level. Man, I'm tripping over my words. Hopefully, does that make sense, Pablo? Right? Median income is 50%, low income is 25% and below. How about that? There we go.
I think that was pretty good. Greg, in all transparency, I was furiously typing in the chat, so I wasn't fully engaged here, but
you were giving me this look like,
no, it was me. No, it was just me. It was my furrowed brow of when I'm typing something. I'm really trying to like get done with it in the chat. And really I'm just going to say it, right? I used the term just now because I think it's really relevant to this, and it's relevant to everything that you and I talk about with categories and being category kings and vertical integration and all that stuff, is this idea that I'm reading a book called Super Consumers. And I just recently called Lee a super consumer. And the base for this book is that article that I sent you about how Main Street is killing Wall Street in the stock market betting on Tesla. Because Tesla consumers are super consumers, right? Everybody that buys a Tesla becomes such a big fan of Tesla that they then go invest in Tesla. And while Wall Street doesn't understand the category that Tesla has created, because it's so different than everything else, they're sitting here making these like judgments on it, while the super consumers of Tesla are making a killing in the stock market, right? So I equate Lee to this like super consumer of JWB, because he's sitting there buying up real estate and adding to his portfolio, because he's been a part of every single one of these shows, and he's become, like a part of all this, and he understands it so deeply. So he's all in and he's able to invest without the noise of people that aren't experts talking about it. I thought that was relevant.
I love that. I think that's completely relevant. Not so much relevant to the question that was asked, which is cool, but totally relevant to what we're trying to do here. So that's awesome. And I love Lee's impact here. Lee's had an incredible impact literally on the show and all the folks that attend now. I mean, yeah. Lee, there's a reason Lee's the godfather. So thank you so much for that, Lee.
He did win Not Your Average Investor Fan of the Year at our appreciation show.
He did. I'll finish up the question that was asked really about defining low income. Okay. So, if you've got median income would be middle income, median home sales price would be middle income. And that's 50%, right? 25% would be kind of the top of the low income, right? So in Jacksonville, your median home sales price is about $270,000, right? So your low income would be below, call it, $135,000 as a sales price. Now take that as a really generalized way to look at it. Don't take that as the end all be all, that everything below 25% is 100% low income neighborhood and you should never invest in it. But hopefully that gives you some bumper lanes to at least know where you are in the ballpark. And, JWB's purchase prices when you purchase homes are between $160,000 and $250,000. So when we're talking about us being in below middle income, that's kind of where we are.
There you go. All right. Daniel Kane has another question. What are some of the criteria other than price and ROI that investors should look at?
Well, I think, not to kind of beat a dead horse, but we've talked about how much more important it is to be working with a company that has its feelers well beyond just property management, right? Like, that's the first critical thing that I think you should be looking at. If you really want to enjoy this investment, it's got to make sure that your goals are aligned on the property management angle. So you got to work with somebody who's doing the property management. Beyond that, you need to work with a company that's invested in the long-term growth of the market, right? They need to be buying significant amounts of properties. They need to be a mover and shaker downtown. They need to affect policy. They need to be affecting decisions that are made. They need to be on boards that are affecting how the city's run. That's a real risk mitigation and return on investment opportunity for you. And then our personal beliefs is that they should be giving back to the communities that they serve as well. So that full line of vertical integration is something that I think is a big differentiator. Well beyond the returns, well beyond the cash flows, you need to be working with a partner who truly controls and has a significant impact all the way down that line.
Yeah, Greg, and if we're gonna get really transparent, if you take JWB out of the equation, right? Like I've learned this from you, and it's the idea that you only make the decision on the property one time, you're going to be in bed with the property manager for the life of the property. Right. So I would say, based on the feedback that I've gotten and being part of the show, if we're going to just take the idea that nobody else does business like JWB, which is a fact, and you're doing it somewhere else in a different city, what you really need to be looking at is who is going to manage that property for you, right? Like, you need to have that in place before you do it, because it'll really, really affect the life of the experience that you have in this investment class.
Yeah. Your 3 decisions should be: number 1, you should fall in love with the team that you're working with. Number 2, you should fall in love with the market that you're investing in. And then number 3, and the simplest and easiest part of the decision-making process, is the property. For many people get that confused. They fall in love with the property, then they fall in love with the market, then they fall in love with the team, and they're sorely disappointed. The property is a widget. It can be replaced. That's why when we were talking about how we sell homes, the whole time we're talking about, are we in alignment for our team and you as a potential client? Do you see the value of investing in a growth market like Jacksonville, which has been shown to appreciate it higher than the national average over the last 30 years, as far as home price appreciation, as well as producing positive cash flow? And then, oh, by the way, here's how all these properties are going to fit. They're going to be between 8 to 10% returns. How about this one? This one works. Okay, great. Wait, that one just sold 10 minutes before you jumped on the call. Okay, cool. Well, there's another one that's exactly like it. It might be 3 streets over. It's the same thing. It's more or less a widget.
Love it, man. I felt particularly useful there, recontextualizing that one. And I'm just going to throw it out there. Daniel Kane, you're my guy, right? He put in the chat, he put great info, relationships in all caps, right? Like, Daniel, I am Mr. Relationships guy, right? Like, it's all I care about. And everything I think about is how to scale relationships. And that is the fundamental basis of like what my service is and what this show has become, right? So, okay, let's go to another one. Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Was this picture of the home taken before or after JWB rehab?
This one actually I pulled off of Google Images. So this one actually is renovated. It is rented right now. I pulled this one off. This one is like a year or so old. So it's before we actually renovated it, but it's largely very similar to, of course, it's the same house. It's the same way it looks right now. I just pulled this one because I didn't want to get a picture where there were cars in the parking lot or in the driveway. And so this was my best solution, because even the photographer went out and saw cars in the driveway. And I'm like, it's not the best.
It's just in.
So there you go.
Gregg hates cars in driveways. Stephen Block, Stevie B from the Facebook group asks, what is the average rent increase year over year in Jax? Or asked differently, how much can we expect the rents to go up on each turnover?
I think macro when I think about rents going up. I try not to get too excited about this, because my theory, and I hope you all follow, is that you're going to be holding on to these for a full market cycle. And over a full market cycle, rents tend to go up roughly with inflation. That's why the fifth profit center in rental property investing is inflation hedging. It's one of the benefits. Rents and home prices tend to go up with inflation. So I would think macro about it, 3 to 4%. Rents going up year over year has generally about what it's been over the long haul. So if I was predicting this, 20 years from now, I'd probably think 3.5%, 4% rents going up is a decent amount each year. I should plan that out, or I should say that going up each year. In the short run here, rents have gone up a lot more than 3.5, and even more than 4%. I've been looking at some of the data that is put together by some of the article publications that we either subscribe to or whatnot. And Jacksonville has one of the highest rates of single family rents, going up to over 4%. I don't exactly remember what it is off the top of my head. Maybe I'll go and find it for you guys and post it on the group. But just recently, it's been more. Again, you're not investing for the next year. You're not investing for what happened last year. You're not investing for the next 3 years or 5 years. Right? I think it's going to go up 3 to 4% a year.
All right, Gregg, we got one last question, man. We got it. We got it done. Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Asks, so what happens in the situation when a renter moves out early, like in Denise's situation? Does the renter owe a penalty or fee for breaching contract?
We can attack it from a couple of different angles. So does the renter owe a penalty or a fee? Yes, right? A lease is a contractual agreement for them to pay a certain amount of rent to you for a certain number of years. And so by the letter of the agreement, what it technically states is, if somebody if somebody backs out of the lease, then the rents are accelerated. Okay. Rents being accelerated would be the same as if you own a home and you stopped making your mortgage payments. The bank and the mortgage accelerate their payments due, and they say, well, if you didn't make this payment, you now have 30 days to pay this, and you have the whole $200,000 that you owe is due in 30 days. They're accelerating the payments for you. And then what happens with foreclosure is people can't pay that off, because who can come up with $200,000 in 30 days if you couldn't make the payment last month? And then the bank forecloses on you. That's actually what happens. Same thing with a lease, right? Your rents are due for the next, let's say, 2 years at a certain rent rate. You don't make the rent, then the rents are actually accelerated. Now that's technically what happens. Has there ever been a resident who missed a rent payment and then the rents were accelerated and paid all of the rent in order to get out of the lease? Absolutely not. It's unrealistic to think that that is ever going to happen. But that's technically the lease. And we use that as a starting point to figure out a good solution for a resident. So there is a penalty. The biggest thing for us is to make sure that they can get out of the home quickly, meaning like once we understand that this is not going to go somewhere, they cannot afford it, they had a job loss, maybe a death in the family or something changed dramatically and we just couldn't see it, we're going to get to an understanding of if this is sustainable, if they can handle it. If they cannot, we're going to ask them to leave relatively quickly so that we can then get this home ready to be re-rented. And we're going to do as best we can to make sure the home is in great shape for you. That's the biggest risk for you. So we want to keep a very positive relationship with the resident. We want to work with them because they hold the keys in a sense, right? If they were to go and beat up your home, that would be a lot of costs coming your way. And we don't want that. And then we try really hard to get the rent paid that is due for that month. And we try to get an additional month of rent paid. It doesn't always work out that way. You know, for me, if they just paid really through the month that they're there and the home was in great shape, that's a win, because this doesn't happen very often. And then I know that our homes are going to rent very quickly, just like Denise's did in that example. And it's going to be in a good spot as far as what your returns will be. So that's just a realistic kind of look at it. You know, we could say technically that we're able to collect and, you know, all this acceleration of rents, but that's just not realistic. It just doesn't happen that way.
Gregg, right when I think that I understand the depth of long-term thinking and your sincerity when you answer questions, you go and answer something like this and totally prove me wrong, man. That was awesome, man. Like I'm as impressed by that answer as anything you've ever done on the show. Just throwing it out there. And that being said, we're gonna drop the mic and walk off like that. This has been an amazing Thursday call. We had a lot of new people. I would love to see you join the Facebook group, right? Like, we're not kidding. I think we're at 1,400 people at this point. We used to call it, huh?
Don't tell us short, 2,400.
Oh, 24. My bad.
Come on, man.
2,400 people. We used to call it the Secret Cool Club. Secret's out, but it's still a cool club full of really, really helpful, sincere people. Gregg goes live in there. He answers question. This is the heart of JWB. It is our community. Please be a part of it. You're going to get great advice on anything that you're looking for as far as like rental property investing and or growing wealth. Some really, really bright, really, really generous people in there. Go to jwbfacebookgroup.com. If you want to download this spreadsheet that I've been tinkering around with, there's a bunch of other tabs we didn't get into, and it's really, really powerful. Go to jwbroi.com. And next week, while Gregg is off giving off a free house to a well-deserving veteran, we got a special guest on the show, Mike Stewart, who has been the architect for the onboarding plan for over $450 million worth of real estate assets. We're going to pick his brain about the best questions that you need to ask, the whys, what you need to be considering before you get on this. It's going to be super, super valuable. And you get to meet Mike, who is somebody that you will probably be hopping on the phone with at some point soon. So you get to know him, get to build some rapport, and it's going to be an awesome, awesome time. Gregg, this is an honor to be a part of this. The fact that we have 40 something people on with us on a Thursday never falls mute on me. The idea that you take this much time out of your schedule to hang out with us. So it's an honor to be a part of this. I will leave you with the last words, my friend.
You know, this is incredible. Every time we do a Thursday show, I think Pablo and I fall more and more in love with the community, with the group, with the show, with the energy you guys bring, with the new names that we have here joining us. It's just so cool. So thank you all for being here. I see some great comments here. Margaret Smith said, you know, you two are so amazing. Just love to hang with you. I just want to say thank you. Comments like that really help. Really, they really do. They mean a lot to us. And we have such a tight-knit group. So Margaret, we really appreciate hanging with you too. Nadeem Shah, prayers for one of the greatest golfers, Tiger Woods. Let's throw some prayers out there for Tiger. That was, I'm sure, shocking to all of us, and we pray for his speedy recovery. And then Marilyn said, enjoy golfing on Monday in the house handoff. So thank you all again for your support, for making this happen. This is a total team effort. Thank you for everybody who has donated and who continues to donate and be a part of the raffle. That number continues to grow. It's over $10,000, and somebody's going to walk away with a nice gift of over $5,000 if you're the lucky winner. And more than that, you're doing something that's amazing for our local community here. You can donate at jwbcares.org/events. In the middle of the page, look for the raffle button. So with that, I will catch you guys next week. You'll see me in the group all the time, and I'm going to share tons of videos about this incredible day on Monday and Tuesday. So thank you, everybody.